Ever wondered what goes behind a great research for stock picking? What's the best way to understand company's dynamic? What are the big fund manager check before adding any stock into their portfolio? It's Techno-Funda Analysis. Every investor wants lowest possible risk and best possible return from their investment. And that can only happen when you pick right stock at right price. To pick a stock with best risk reward ratio, one should always keep in mind few factors like company management, price safety, business outlook, and technical trend. The first two factors, company management and price safety, can give you hint about the risk associated with the company, while other two factors, business outlook and technical trend, can give you idea about entry point and potential upside. There are two major risks which investor needs to understand before investing in any company. That is fundamental risk, which arises from poor fundamental and can wipe off your capital permanently. Other risk is price volatility, which is temporary in nature. To avoid this risk, one should always try to understand how company's management is conducting their business, whether company's health is in good shape or not, whether management is using company's fund appropriately or not. This will make sure that one doesn't lose their capital permanently. Balance sheet ratios like debt to equity, current ratio, quick ratio can give you brief idea about the financial health of the company, while return on equity, return on capital employed, asset turnover ratio can help you to understand how well management is using company's funds. Let's understand with an example. JP Associate consistently had given multi-bagger return throughout 2004 to 2007 period, and in early 2008 it got added into Sensex and Nifty. Post that period, JP Associate raised significant debt to fund their growth plan and to sustain higher growth rate. But JP Associate was not able to generate enough cash flow to pay interest and started falling from 180 level in late 2009 to 5.5 rupees in 2016. Stock went further down to 1 rupees in 2020. Price volatility risk is temporary in nature, but it has been observed that any wild fluctuation in price can trigger panic among the investor, which leads investor to sell their holding at wrong price. To manage risk, investors should segregate stock in few categories like large cap, mid cap, small cap, or high volatility and low volatility stock. It's very easy to find market cap of the company and segregate them. But to find volatility, one has to use standard deviation or use average true range indicator, which can be found in every chart software. To reduce risk, one should assign a higher allocation to lower volatility or large cap stock and lower allocation to higher volatility or small cap stock. There is a saying among the investor, stock market is slave of earning, which means without profitability, no stock can sustain higher levels. To get a sense of same, one can compare historical sales growth, margin and profit growth numbers with recent results. From that, one will be able to understand whether a company's growth is getting better, worse or going nowhere. Any improvement in sales, margin or profit growth will be cheered by the market and will increase the potential of stocks to go higher. There are two ways to find good entry point. First, fundamental valuation. It requires forecasting or estimation of future sales and profit numbers, which requires deeper understanding of business. This can be time consuming and suitable only for long horizon. Second, technical analysis provides insight for short term as well as for long term using historical price action, which is also relatively easy to understand. That's the reason more and more investors are using technical analysis to find future price performance or to find good entry point and exit point. There are several technical indicators which can help you to determine trend. One of the simplest way to find bullish or bearish trend is by checking highs and low for particular period. It can be one day high or low or 1 year high or low. It completely depends on how long one want to invest in. If stocks are making higher highs and higher lows, then stock is in bullish market. While on flip side, if stock is making lower lows and lower highs, then stock is in bearish trend. Let's understand business outlook and technical trend with example. After 2008 crash, Reliance stock price never touched its 2008 high level for next 10 years, mainly because Reliance revenue growth was flat between 2011 to 2016. In September 2016, Reliance Jio was launched. Prior to that, petrochemical and refinery was contributing 91% of Reliance total revenue. In February 2017, Reliance stock price crossed 600 mark, which was great surge price after April 2008. In October 2017, Reliance crossed its 2008 high of 816 and started fresh bull run. During 2016 to 2018, Reliance posted positive revenue growth. Reliance revenue has grown threefold since 2016 with the help of Reliance Jio and retail, which now contributes 48% of the revenue. Meanwhile, stock price went up from 600 to 2400 till March 21st. In conclusion, technical analysis and fundamental analysis both complement each other, and to become a successful investor, one should check fundamental and technical factors. If one doesn't want to put effort and time to check given factors, hop on to Stratzy app. It will be your virtual investment guide with a user-friendly interface. Check out the Insight section where we have considered all above mentioned factors and provided stock rating in order to make it simpler. And last but not the least, to make your investment journey smoother, check out the courses on upsurge.club.